Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've talked a lot about the local share market so far this year, but investors are increasingly looking for opportunities overseas as well. So I wanted to get an insight into what investors can expect on global markets. Remember, this is general information only. You should get professional advice before making any investment decisions. Nick Healy is Portfolio Management for WAM Global, part of Wilson Asset Management. Nick, welcome to Fear and Greed.
Thanks, Sean. Thanks for having me.
Now, whenever we talk to anyone from WAM, we tend to get a great response. I don't put any pressure on you, Nick, but that's what I'm just putting there up front. So,
it is a very solid team. I'll see how I go.
I'm sure you're up to it. Tell me, what are some of the big themes to watch out this year in global markets? It's about inflation, but what about beyond inflation?
Yeah, I think this year for me will be a year of the market sorting mechanism really stepping into gear. So if you think of last year as the first year of a bear market, what tends to happen is in those early stages, assets get repriced relatively indiscriminately. And then in the later stages, I think this year, we're going to see a situation where the better stocks tend to outperform, the poorer stocks show their worth, and the better management teams underpromise, overdeliver, and really control costs and drive really good outcomes for investors. So I think the theme for me this year is that it's a sorting mechanism and a year of efficiency.
Okay. So kind of the best managed and the companies with great best fundamentals are likely to outshine some of the others broadly.
Yeah, I think so. I think you're already seeing it, to be honest, with... So for 2021 and prior, those were environments where really you didn't have to show profitability. You could always tap the capital markets. It was a very favorable environment, basically regardless of your economic model and how high quality of a company you were. I think what we've seen, Palantir and Meta, now we hold neither of those stocks, but I think they're fantastic examples.
Sorry, what was the first one? I missed that.
Yeah, Palantir, they do kind of defense software.
Palantir, yep.
So I think they're fantastic examples of really being rewarded for showing cost control, showing discipline, underpromising and over-delivering. So Palantir had results where they had their first profitable quarter ever, which seems incredible to think about for such a highly valued company. But they did, and the market rewarded it with the stock price moving up over 20%. And we know Meta, which is a much bigger company, they had their famous year of efficiency result, and they promised $5 billion of cost out. And also in that case, the market moved the share price up by over 20%. So I think other CEOs definitely look at these signs in terms of what the market is rewarding.
Okay, so you mentioned a couple of companies there. We've sort of had most of US earnings season now. What are some of the key takeaways from that?
Yeah, I think it's a really interesting earnings season because if you asked the kind of average market participant, my view is they would say that this has been a really favorable environment. The performance has been strong. I think this is really just price driving narrative, which we see all the time in the market. Actually, I was reading some research yesterday from Credit Suisse, who said that if you look at how earnings expectations have changed, this is the worst earnings outside of a recession in over 2 decades. So I think it's a timely reminder basically to just make sure that you're thinking about how the fundamentals are performing and not to get caught up in the price movements.
Okay, so on that basis, tell me, can you nominate an undervalued company that we should be keeping an eye on?
Yeah, I think a great example on that front would be Icon, which we hold in the fund. So Icon had a relatively tough 2022. At one point, the stock was down over 40%. And importantly, what Icon do is they help pharmaceutical firms shepherd their drugs through clinical development.
Right.
So this is not a kind of company that will see significant earnings decay. It's very economically acyclical, very safe. But price drives narrative again, and so when the price was down, everybody was looking for issues. Now, Icon had a really positive update at the JP Morgan Healthcare Conference in January. They outlined mid-single-digit growth, margins expanding, really no problem, and the market treated that really positively. So it's just an example of, I think it's always important just to focus on how the fundamentals are going.
I know another one you've spoken about is Booz Allen.
Yeah, absolutely. So we really like Booz Allen. They are the best in class consulting firm for the US defense and intelligence communities. Now, obviously, we're seeing in the news there's a lot of friction with regards to the geopolitical situation. You would be hard-pressed to find a bipartisan issue in the United States government apparatus. Defense is that bipartisan issue. So both sides of the aisle definitely want to spend, and Booz is really well positioned to benefit from that. So Booz actually had what we thought was a fantastic result, really strong. They've been struggling to hire in 2021 just because tech has been taking all of the talent. That's starting to get better with some of these tech layoffs. So we thought it was a great result. The market sent it down 6% on the day, and we just think that's fantastic. So we added to our position. We definitely are more of a how are the fundamentals, and happy to take advantage of Mr. Market.
Stay with me, Nick. We'll be back in a minute. My guest this morning is Nick Healy, Portfolio Manager for WAM Global. Okay, I'm going to talk about Volkswagen then, because its share price has really fallen pretty sharply over the past couple of years, a little less than that. It's about half what it was, notwithstanding it's probably had a good couple of weeks recently. Is this the sort of company that you're talking about? Good fundamental, but kind of, it's almost like the losers from 21, 22 might be the winners in 23?
Yeah, I think Volkswagen's a very interesting company because you can do a very interesting sum of the parts on it. They hold a 75% stake in Porsche after recently IPOing 25% of the holding. Now, anyone that's driven a Porsche will know that these are just fantastic vehicles, lots of brand love, basically a luxury good. And the market is rewarding the Porsche trading company at over $100 billion of market valuation. Now, Volkswagen Group, which, as I said, owns 75% of Porsche, can be acquired today on the market for $75 billion. So it doesn't take very impressive mathematical skills to figure out that you get the rest of the Volkswagen Group for free. So that's things like Audi, Lamborghini, and their mass market brands. All combined, they produce over 6 million cars a year. This is just an incredible thing to be given for free. Now, I would say in this situation, it will take patience because clearly a car company will be exposed to the kind of slower economic environment we may see over the coming year or two. But just the value disconnect on offer is very compelling.
Okay, so we've seen quite a move in recent weeks in equity markets. And I mean, I just want to talk about US Wall Street versus other markets. But just before we go there, is it such that because we've seen that move, a lot of the at least short-term upside might not be on offer like it was on the 1st of January?
I think absolutely I would concur with that thinking. We've seen, and you do tend to see this in bear markets, we've seen over 2022 and into 2023, the primary driving force is clearly inflation's been very strong. That has forced central banks around the world to take rates up. That's not great for equities. But you've seen this choppiness of trading where at certain points in the cycle, I think of May and October, fear was everywhere, pessimism was everywhere, and stock prices were really low. Alternatively, right now is a time when it does feel like optimism has kind of returned. The fundamentals haven't changed that much. So we think it's probably a situation where you want to be more selective and cautious, maybe not trust this rally so much.
Now, one final thing, Nick Healy, Portfolio Manager for WAM Global, that I want to talk to you about. I want to talk about the US versus Europe, but I want to do it a little differently. And you've led me being the horse to water here, and I want to drink the water. Actually talking about specific companies in the US versus a competitor in Europe. So is it Kone versus Otis, the elevator crowd?
Yeah, Kone.
For example,
Yep.
Sage versus Intuit, the software groups. How do you actually think about these companies? Does it matter where they are, whether they're in Europe or the US?
Yeah, I think this is a perfect kind of conversation to have along the field of making sure that you're looking at stocks individually and bottoms up. So we hear in the market constantly the concept that this area is cheap or that area is cheap. So there's been this idea that Europe is exceedingly cheap compared to the US. Now, our work says when you look stock by stock, you do tend to see situations where there actually are fewer high quality companies in Europe There's a lot of captive asset managers, say a portfolio manager that can only invest in the UK. So they're going to hold those high quality companies, and you'll see situations where they can trade at valuations that are less appealing than in the United States. So I think you threw out some really good examples. So Kone is number 3 in the world in elevators. Otis is number 1. You can have Otis at a cheaper valuation than Kone. At the same time, you can get Intuit, which is just a far better cloud-enabled accounting and business software company. Sage has done a much poorer job. You can get those at very similar valuations. And so I think it's just a bit of a pushback on the narrative that this area is exceedingly cheap, and it's all about individual stock picking.
So it's kind of less relevant where they are. I mean, particularly if they're operating in global markets like Kone and Otis, for example, and Sage Intuit, it's less relevant where their home base is.
100%. So many companies these days are extremely global. There will be translational FX effects, but at the end of the day, that doesn't matter. It's the end markets that they serve.
Fantastic. Nick, thank you very much for talking to Fear and Greed.
Thank you, Sean. Really appreciate the time.
That was Nick Healy, Portfolio Manager for WAM Global. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.